The concept of shared ownership in ventures dates back centuries, but the formal stock market traces its roots to 17th century Amsterdam. The Dutch East India Company, a global trading powerhouse, needed capital for its risky voyages. They began issuing shares representing fractional ownership to investors. These shares could be bought and sold, creating the world's first true stock market. The Amsterdam Stock Exchange, established in 1602, became a hub of activity, with traders gathering to buy and sell shares based on speculation and information. The success of the Dutch East India Company and the Amsterdam Stock Exchange inspired similar ventures across Europe. The American colonies, initially focused on agriculture and resource extraction, were slow to embrace stock trading. However, the need to finance infrastructure projects such as canals and railroads spurred the development of a rudimentary stock market in the late 18th century. Early stock trading in America was often conducted informally, with brokers meeting under a buttonwood tree on Wall Street in New York City. The formal organization of the New York Stock Exchange in 1817 marked a turning point in American finance. The NYSE provided a centralized location and standardized rules for trading, fostering trust and transparency in the market. The Industrial Revolution, with its demand for capital-intensive industries, fueled the growth of the NYSE and other regional stock exchanges. The rise of railroads, particularly in the 19th century, created immense wealth and spurred speculation in the stock market. As the stock market matured, key figures emerged, leaving an indelible mark on the world of finance. Charles Dow, a financial journalist, and Edward Jones, a statistician, co-founded the Wall Street Journal in 1882, providing investors with timely and accurate financial news. Dow's creation of the Dow Jones Industrial Average, a price-weighted average of 30 prominent companies, provided a benchmark for tracking the overall health of the stock market. Jesse Livermore, a legendary trader known for his ability to predict market swings, amassed a fortune through speculative trading. Benjamin Graham, known as the father of value investing, advocated for a disciplined approach to investing. These pioneers, each with their unique contributions, shaped the landscape of Wall Street and laid the foundation for modern investment strategies. The Roaring Twenties saw unprecedented stock market growth fueled by margin buying, but on October 24, 1929, Black Thursday, the bubble burst. The crash marked the start of the Great Depression, wiping out countless savings. The Securities Acts of 1933 and 34 aimed to restore confidence and prevent future crises. The post-World War II era witnessed the rise of a new breed of technology companies. These companies, driven by innovation in electronics, computing, and telecommunications, required access to capital to fuel their growth. The National Association of Securities Dealers Automated Quotations, or NASDAQ, was founded in 1971 to provide a platform for trading securities of these emerging companies. The NASDAQ, with its focus on technology and innovation, quickly gained a reputation as a hotbed for growth stocks. The advent of personal computers in the 1980s, followed by the internet in the 1990s, created a surge in demand for technology stocks, propelling the NASDAQ to new heights. The NASDAQ's electronic trading platform, a departure from the traditional floor-based trading of the NYSE, facilitated faster and more efficient trading. The rise of the NASDAQ reflected the growing importance of technology in the global economy. The late 1990s witnessed an unprecedented surge in internet-related companies, fueled by the explosive growth of the World Wide Web. Investors, captivated by the seemingly limitless potential of the internet, poured money into dot-com companies, driving their valuations to stratospheric levels. The NASDAQ Composite Index, heavily weighted towards technology stocks, soared to unprecedented heights. However, the dot-com bubble, as it came to be known, was built on speculation and unrealistic expectations. Many dot-com companies lacked viable business models, generating little to no revenue, yet their stock prices continued to soar. The bubble burst in early 2000 as investors realized that many of these companies were overvalued and unsustainable. The dot-com crash served as a stark reminder of the dangers of speculative bubbles and the importance of sound investment principles. The 2008 financial crisis exposed the interconnectedness and vulnerabilities of the global financial system. Originating in the U.S. housing market, loose lending standards and complex financial instruments created a bubble. As housing prices declined, the bubble burst, triggering defaults and losses. Banks, burdened with toxic assets, faced a liquidity crisis, worsening the downturn. Governments intervened with bailouts and stimulus packages to stabilize the system. The Dodd-Frank Act in 2010 aimed to strengthen regulations and protect consumers. The advent of powerful computers and sophisticated algorithms has revolutionized the way stocks are traded. Algorithmic trading, also known as algo trading, involves using computer programs to execute trading orders based on pre-programmed instructions. These algorithms can analyze vast amounts of data, identify trading opportunities, and execute trades at speeds far exceeding human capabilities. High-frequency trading, or HFT, a subset of algorithmic trading, involves executing a large number of orders at extremely high speeds, often in fractions of a second. While proponents argue that HFT enhances market liquidity and efficiency, critics contend that it can lead to market manipulation and exacerbate volatility. Regulators have grappled with the challenges of overseeing this complex and rapidly evolving field, seeking to ensure a level playing field and prevent unfair advantages. The debate over the impact of algorithmic trading on market fairness and stability continues, highlighting the need for ongoing monitoring and potential regulatory adjustments. The 21st century has witnessed a democratization of stock trading, thanks to the proliferation of online brokerage platforms and mobile trading apps. These platforms have made it easier than ever for individuals to access the stock market, invest in companies, and manage their own portfolios. The rise of commission-free trading and fractional shares has further lowered the barriers to entry. However, this increased accessibility has also coincided with periods of heightened market volatility. Social media platforms, news aggregators, and online forums have become influential sources of information, shaping market sentiment and driving trading decisions. The rise of retail investors, empowered by technology and emboldened by online communities, has at times contributed to market swings. The GameStop short squeeze of 2021, where retail investors coordinating on social media platforms drove up the price of a struggling video game retailer, exemplified the potential impact of retail investors on market dynamics. For those new to the world of stock trading, the sheer volume of information and the complexities of the market can seem overwhelming. However, by adhering to some fundamental principles, novice investors can approach the market with greater confidence and increase their chances of success. Firstly, it is crucial to invest in what you understand. Before investing in any company, take the time to research its business model, industry, competitive landscape, and financial performance. Understand the company's products or services, its target market, and its growth potential. Secondly, diversify your portfolio. Don't put all your eggs in one basket. Instead, spread your investments across different companies, industries, and asset classes. Diversification helps mitigate risk by reducing the impact of any single investment on your overall portfolio. The future of stock trading is shaped by technological advancements, evolving regulations, and shifting economic paradigms. AI and machine learning automate investment decisions, identify patterns, and generate insights from vast data sets. Blockchain enhances transparency, security, and efficiency, transforming trading. DeFi disrupts traditional intermediaries, creating new avenues for trading. ESG factors are crucial in investment decisions, aligning portfolios with values for a sustainable future.